So DSCR stands for debt service coverage ratio, and really simplified, all it really is rents divided by payments, right? So it used to play into, I think it back in the it kind of came from maybe the commercial side, from what I understand, but then it's kind of developed into this new loan product for investors, which it has some advantages, for investors as well, as far as not touching doesn't go on your debt to income. It doesn't. We don't report these to credit, so it's got some advantages there. But DSCR, so rent divided by payment. We again, these are not asset based loans, right? So um, or let me back that up. They're not income-based loans, right? So
Mm,
they're asset-based, which means
yeah.
we don't look at tax returns, W-2s, income statements, anything like that on the borrower. All we really need on the borrower is a credit score, which we'll probably go over here in a little bit, and then we focus everything else on the asset itself. So DSCR, so rents divided by payments. Rent would be if rents cover the payment exactly on the loan, that's one DSCR, so it's break even. Anything above one DSCR means it's cash flow positive, right? So most investors are going to want it to be, one and a quarter higher. I'm not sure what you teach to your students or your folks, but yeah, if you want to be cash flowing, obviously that's important.
Yeah. So what DSCR requirement do you guys have? Is it one or is it one and a quarter?
So on short term rentals, it's one, right?
Okay.
So a lot of companies it is one and a quarter. With us, it's one. On long term rentals, we can go down to 0.85. But we have to do a review on that property, get a kind of a business case put together on why we should lend on, a sub one DSCR. But we've done it. If it's a situation where rents are going to be raised, or it's kind of an up and coming area or something like that, um, that'll be taken into account. So
Okay. And when you say payments, does that include taxes and insurance or just the mortgage?
yes, that would be taxes, insurance. That's pretty much all the PM, everything. Your whatever the monthly payment is on the loan. Put it that way. So yeah,
Got
that
it.
would be your full mortgage payment.
Okay. So I'm sure there's probably a few people who were trying to do some mental math there and might have missed some of this. So just as an example, rent divided by payment. So if you're making, you buy a rental property that's bringing in $1,500 in rent per month, in order to qualify for the DSCR loan, one to one ratio, your payment needs to be $1,500 or less. So if it's more than that, then you're not. You can go up to, on a long term rental, you can go up to 0.85, but if it's a short term rental, one to one. Um, so yeah, that basically the reason for that is then the lender can look at the property to pay back the lender as opposed to you needing W two income. So anyone, like I haven't had a job in 4 years, and so I've done
Right.
lots of these over that time period. Um, and so I think a lot of people think that, well, I don't have income, I can't do deals. This is a perfect product for that.
This is it.
Yeah. So you said, you don't know what I teach. Like for us, we're nowhere even close to one. Like if we're close to one DSR, then I would recommend not buying the property.
Right.
Typically, we're closer to like two DSCR. In my opinion, that's the better way to go. Is buying a property that cash flows really, really well. So,
100%. Yep,
um,
I agree.
so uh, um, what are the qualifications for people then? If they're so you mentioned credit score. What type of credit score do they need, and then what else do they need to provide to qualify for one of these loans?
Yeah. So qualification first is going to be credit, right? So we need a 680 or higher credit. 680 is
Okay.
our minimum. Anything above 760 is going to be our top tier pricing. So rates are going to be pretty heavily weighted on credit score. The difference between a 680 credit score and a 760 credit score is almost a full point, right?
Wow.
So yeah, so it's a big thing when you're doing this, and you want to have shiny credit, right? You want to try to get your credit up as high as possible. Um, that way you're going to be getting better rates on all your properties. So that's one. Along with that 680, so it goes in 20-point increments. So 680 to 760. So it's all tiered pricing in between that. In 20, so for instance, 680 to 699, 700 to 719, and so on up to 760. Everything above 760 is going to be top tier pricing. And then we
Got it.
also require three established trade lines, right? So if you've got somebody like fresh out of college or something like that, we do want to see, or just a new, we want to see three established trade lines. That means 24-month history on three established trade lines. Could be credit cards, mortgage, card note. anything like that. But that way we want to look at payment history, right? We want to just make sure that the borrower's got, hasn't been making a bunch of late payments, things like that, because that can kind of carry over into a loan, right? So
Hmm.
we look at that. And let's see, on short-term rentals, we do have an experience requirement. Long-term rentals, we do not. So long-term rentals, you can be a first-time home buyer, no experience required. Short-term rentals, we do want to see 12 months mortgage experience within the last 3 years.
Mm,
So, and that could be personal, your primary, or that can be investment properties.
got it. Okay. Um, that makes sense. And if somebody doesn't have the experience, could they partner with somebody else as like a co-signer on the loan, or how does that
So we
work?
don't do, it wouldn't be a co-signership. So if it's going to be multiple like business part, investing partners, it needs to be in an entity, right? You would need to form an LLC or some kind of entity. The only partnership, I guess, would be if it's a spousal couple, right? If you got a with a spouse, then we can do it individual. But as far as on if it's going to be you know two you know two investors, it's going to, yeah, they would need to form an entity for us
Okay.
to be able to do that. There wouldn't be co-ownership or anything like that. And then we take the primary guarantee. So in an entity situation, we only use one of the members' credit, right? So the primary guarantor would be who we would use, and they need to be an equal or majority owner in the entity. So if it's a two-person 50-50 or higher, three-person, and so on, they just need to be an equal or majority owner for us to use them.
Got it. Okay. So you form an LLC, create a operating agreement that just says that you're both owners on it, at least 50% if you're going to be the signer on it, the primary. That makes sense. Okay. And then when it comes to getting like a pre-approval letter, because like I know a lot of people, that's the first step is they want to get a pre-approval, but they don't have a deal yet. So how does that process work? Do you just run their credit initially, and then how do you know what they're approved up to?
Yeah, so as process kind of usually what I like to do is run numbers on the property first, right? That's kind of a baseline start. Take a look at it, see what we're looking at here. At that point, if they decide, hey, I'm going to make an offer on this property, I like it, then they can come to me and I can write up I've got a pre-qual letter I can send over that works 99.9% of the time, and that's pre. Don't have to pull credit before that, right? At this point, we're kind of going off honor system because at point of applications when we're going to pull credit and then we're going to see, right? So, but yeah, for that pre-qual letter, I can get that sent over right away. Usually, sometimes when I'm quoting it, if they ask for a pre-qual letter, I can send it all together, and then go get it done. So, pre-qual
Awesome.
letter is easy. That's an
Yeah.
easy step. Yeah,
Yeah, and I hear people all the time that I work with, like, that are just getting started. They use that as an excuse not to be putting in offers, and I tell them like it's actually not that big of a deal. Like
right.
again, like you mentioned, it's sort of like the honor system. You're giving information to the lender, and they're saying based on what I'm hearing, yes, you're qualified for this. And then there's a lot of more work after you get it under contract, but um, you shouldn't let that hold you back. You can get a pre-qualification letter pretty fairly simply. So
Yeah,
that's great.
as long as the numbers work out and look good, then yeah, for sure. I mean, it's
Yeah,
that's good. That's kind of the way that the process works with us for sure.
yeah, and that's a good point too. Like it's a good screening mechanism for the investor. Like if you look at it and you're like, dude, this this deal doesn't make any sense. You're going to lose
I'll
money on a
tell them.
monthly basis. Yeah, it's
Yeah, I
like
mean, it's
yeah,
kind of a no-brainer. I mean, yeah, I mean, if you want to get into a situation like that, but yeah, it's usually I'll kind of be the dealer at the table kind of and be like, you know, might might want to double check on that.
yeah,
Not want to
yeah,
go that direction, right? So
yeah, yeah. And that's I remember in the beginning when I was just getting started, I was kind of frustrated at lenders who would say, "Oh no, this isn't a good deal. Or I won't lend on this." But looking back, they probably saved me on some deals. So
yeah,
use that.
right.
So I guess what are the biggest reasons that you see most people get denied then for financing?
Yeah, I mean, obviously credit, right? One of the big things is a lot of folks don't understand on credit that there are different versions of FICO, right? FICO's got FICO 1 through FICO 10. So they'll look at their credit card or through their bank and they'll pull FICO 8, for instance. So FICO 8 is a very generalized credit version. It's always higher than the credit version. So we pull credit
Mm,
version 2, 4, and 5. That's what we're pulling, and that's usually what most for lending, for mortgage lending, that's what they're going to pull. So folks will see that, they'll pull off of their bank, or through their credit card, they'll pull it, and they think really high number, and then they come to me, and then we pull it, and they're like, they don't understand why it's lower, because usually these the FICOs we pull are going to come in lower. So that's a big scene. If somebody's like, oh, I got 680 on, and they're pulling FICO 8, they're probably going to be around 650 on the mortgage. So that's one big thing. I always tell people it's worth, so myfico.com, not affiliated with them at all, but that's the best place you can go that we found, where you can actually pull, like soft pull those particular versions. And usually folks that I have that are using that, when I pull credit, I mean, it's pretty much spot on. So
Mm.
it's a paid service, but you can cancel at any time, right? So if you want to monitor your credit and get it to a certain point, that's probably a pretty, not expensive. It's a pretty good investment just to do that, just to make sure, because these investors, they kind of live and die by their credit. I mean, when you're getting ready to get a property, you don't want to, if you've got something forecasted next month, you don't want to load up your credit card this month, right? You want to kind of think that out before you, because maxing out credit cards is gonna spike you, or gonna drop your credit. So that's one thing to think about, where your credit's going to be. Because again, like I said, the difference between 760 and 680 is a full point on rate, which is over
Yeah.
time that could cost money. So
Yeah. Interesting. Yeah. So the FICO score is 1 through 8. It's basically like how in depth or how deep of a pull it is. And so is that why it's typically less, because it's less generalized?
probably so. Yeah, it's a little bit more
Yeah.
generalized towards, yeah. If you go to
Um,
myfico.com, they've got like you can just type up their FICO versions, or Google it, FICO
okay.
versions. I think there's a really good one with myfico.com, and it explains every single one of them. So if you want to kind of get versed in that, I would recommend. It's a good fast read through. So,
Yeah. Cool.
but that's one reason people get denied. Another reason is just if the properties are too unique, right? So we only lend on certain. We don't lend on, we lend on. I'm not gonna say we don't lend on log cabins. So it just really depends on the property itself. If it's like in Seaverville, Tennessee, a really the really nice kind of modern log cabins, style properties, then we definitely lend on those. But if it's out in the middle of nowhere, and it's kind of a Lincoln log type, cinched together type cabin, we will review it, but don't usually get that. Sometimes properties can be a little bit too unique. Like I had
Mm.
somebody that brought me a tree house. It was really nice. It was made by the tree house guys, or whatever, that one guy that builds
Yeah.
those tree houses. It
Yeah.
was
On
amazing.
HGTV.
But
Yeah.
yeah, we couldn't lend on it. But yeah, so that would be, I guess, unique properties. I'm trying to think what else might be a barrier to non-owner. If it's owner occupied at all, we'll deny it. So right, so and that includes at arms. So if you got siblings, or you want to put a kid in there, one of your children, or spouse, or not spouse, but like you know parents, uncles, aunts, that these are non-owner occupied loans, right? And that there's a law around that. So we've got to, monitor that. When we go through, if we find that that's the case, then yeah, it can flag the loan and kill the deal. So, so these are investors. You want to investment, loans. You want to kind of make sure that, kind of family out of it as far as on when we're lending on them. Yeah.
Yeah. That makes sense. And to your point on the credit too, you mentioned something earlier that I think maybe some people didn't hear, or I just want to reiterate, is that these loans don't show up on your personal credit. So the great thing about this is, like, you can keep doing it. I mean, do you guys have a limit on the number of DSCR loans you're willing to do?
I mean, so our guideline minimum is eight per month, right? But that can be exceeded with a review. If somebody brings me a
Yeah.
10 pack of refinances they're wanting to do, or scooping up a bunch of properties, we can usually get a review to do it. I mean, we'll look at the borrower, obviously,
Yeah.
but we've got a $2.5 million exposure limit, right? So once a borrower gets to that level, then we'll reevaluate. Have our executive routine or executive review team will take a look, at the they'll go in and look at the borrower, right? See if this guy's solid, making payments, everything like that, and then I mean, 9 times out of 10 they'll give the increase if it's a solid borrower. So
Yeah.
every time
Yeah. I
I've
don't
gone to
know.
bat for folks, they give me an increase. So
Got it.
Yeah.
Yeah, and I don't know too many people who are doing more than 8 deals a month right
Right.
now.
Right.
So,
Exactly.
uh,
Yep.
so
Yep.
that I mean, but that's the cool thing about it is like a lot of people are probably worried. Well, if I do one of these, it hurts my credit because it's a new credit line on my credit, but it doesn't show up. So, like,
No.
we have really high credit. My wife and I have really high credit because we really don't have any consumer credit on our. We just have our personal mortgage on our credit, and
Right.
that's it. Um, but yet I have millions of dollars of loans out there on DSCR loans that are off my credit. They're business. They're basically treated as business credit because they're in the name of my business. Those are all in
Yeah.
LLCs. So I can consistently buy more properties without it impacting my credit score, which is really great.
Right.
So
And just debt to income. Obviously, if it's not on your credit, it's not hitting your debt to income too, right? So
yeah,
you get folks that are come in and they've got, they'll do a couple conventional loans, and then you get squeezed at a certain point once you've got enough a couple properties on your credit and debt to income. That's when we look a lot more shiny, or folks just start out with us and they can just, if you can come up with a down payment, then we can, you can start building out and stacking properties.
yeah. And
That's
can
kind of
you
it.
partner with someone on the down payment? Or how does that work? Have you seen people get kind of creative around that? Because obviously everybody runs out of down payments at some point.
Right. Yeah, I mean, they would just have to form an LLC, like I was talking before. And we don't really do crowd sharing where it's like 15 people coming in and, and
Yeah,
going on investment type of property. But usually in a situation like that, if you've got somebody that's kind of the money man and, they're wanting to partner up with somebody else, then absolutely. I mean, they can, or if they both want to go in, you know, dibs on it or whatnot. Yeah, they would need to form an LLC. That's
yeah,
all we would need. Yeah, no problem.
yeah. So I mean, this should not be an impediment for people either. Like if you go out and you find someone who has a 401k, self-directed 401k or IRA, you could just form an LLC with them. They bring the money to the table. You do all the work. You split it, whatever, 50-50, 40-60, whatever, in the operating agreement, and then you can still get those deals done. So, such a great option.
Another good thing on that note right there, seasoning of funds, right? There's no seasoning of funds with us, so we're not at bank statements, um, income statements, anything like that. So we're not going to dig back. And a lot of times in conventional, they'll pick you apart. If you put a deposit in there or you pull money out, they're gonna as long as it's in the account. When we go through and check to make sure that the down payment's there, we're checking boxes and moving on. So